Hello, this is Stevie Vicks here, broadcasting from Connecticut, home of the wealthy. Today we're going to talk about Bitcoin valuation, how to evaluate cryptocurrencies. We covered in a video last time how they're not a scam, and now we want to cover how they're valued. So I have my reading glasses on today because I have a little presentation here for you. And so let's go. Um, I'm gonna use kind of a couple of models here. One is a kind of an academic paper written by Timothy Peterson about how to value Bitcoin, written about 5-6 years ago. Um, so most of the content in this is going to be from that. And then I wrote about 7 years ago in 2014 a couple of analytical models about how to value Bitcoin, which have turned out to be very accurate actually. So I'm going to cover those in the end. So Bitcoin is, the very first thing that you can think of Bitcoin. It's a network, right? It connects to people, and they can. It's a peer-to-peer network for exchanging value. So at the very core of it is a network. So you can use a network model to value it, right? So there is a set of um, there is a set of so there is a set of um, network models that explain how to value a network. There is the Sarnoff law, there is the Metcalfe law, and then there is Reed law, and there is a couple other laws that are not so important. But basically, Sarnoff law says that the network value increases based on the number of nodes that the network has, right? The number of endpoints. In the world of Bitcoin, that's going to be the number of wallets, the number of things that can transact with each other, right? The second model is Metcalfe law, which basically looks at the interconnections between all the nodes, and the number of interconnections is usually basically the square of the number of users, or in this case, the number of wallets in a system, right? And then the third one is Reed's law, which basically says that as things grow, there's groups that form and so forth, and that the value of the network grows even more so. So Timothy Pearson, he's a famous alternative analyst. He's written about valuation of various assets, and then he also wrote, in private equity, in hedge funds, and so forth. And he wrote a paper about about Bitcoin, and basically he ran all the Bitcoin kind of models against these three models. And then he found out that Metcalfes Law is the one that applies the best to Bitcoin. That same guy also has found that, for example, Facebook growth can be explained a lot with Metcalfe's Law, and Twitter and so forth. So Robert Metcalfe is the chairman of the 3M organization. So he's a guy, one of the Silicon Valley's, major figures from the 70s and the 80s. He has like a medal of, presidential medal. George Bush gave him one. So the guy was a big guy, a very important guy in Silicon Valley 20, 30 years ago. So so this Metcalfe law carries his name. He came up with it. And you can see it right here. And basically, the value of a network grows with the square number of its users. So what Timothy Pearson did is he uses an analogy about gettoni, right? So gettoni is basically a token that the Italians used to use back in the day to to make phone calls between each other, on the pay phones that were in Italy, like back in the 70s and the 80s, right? So at that time, Italy, they used to have the lira, they didn't have the euro yet. And so the Italian government was printing a lot of money, right? So these tokens that people had, they at the same time they were adding more and more phones, right, to the Italian network as the network was growing, and then people, were using more and more of these tokens. But basically, what happened is they started hoarding these tokens because the value of the token doubled and doubled and doubled, right? So they became more valuable than the lira. So in a sense, they became good money. People started, keeping their money in the getoni as opposed to in the lira, right? So um, they kind of became a store of value, the getoni, right, in the 80s. So um, what Timothy Pearson finds out is that kind of the behavior of the Gitoni, the number of users that had Gitoni, was very closely matched to Metcalfe's law, and he finds that that's a very good analogy for what's happening with Bitcoin, right? So Bitcoin, you have a network, and basically the primary purpose of that network is for people to exchange a value, right? So, and then it has a token, which is a Bitcoin, which is kind of a unique token, so to speak, and so people can hoard it, right? So, um, let's kind of dig into the mechanics of Metcalfe's law here. So basically, there's two things that are important in this: the number of wallets, the number of active wallets on the network, right? The number of and the number of bitcoins, basically the supply that is out there, right? So based on just these two numbers, right, Timothy Pearson can calculate the price of Bitcoin, right? So if you have more and more active addresses, right, the value of the network grows. But as the network gets very, very big, basically, the thing grows up exponentially, but at some point there is a notion of decreased returns, right? So you kind of have to smooth out at the very big number. You have to kind of start smooth out the network of the value kind of matures and doesn't increase as much, right? So that is represented by a thing he calls a Gompertz sigmoid, right? So basically, I'm not going to go into the mathematical details, but basically, you use the number of wallets to find out how many possible transactions there can be, and then you basically use the number of bitcoins to kind of plug into this Gompertz sigmoid to kind of smoothen out the network valuation, right? So based on just these two numbers, right, he puts this table right here, right, and then based on just these two numbers, he puts up these tables and he can calculate the value of Bitcoin over a 7-year period. So he does the math here. This is the value that he got. Is this column right here, right? And this is the actual price of Bitcoin. So then he runs the regression, and then he finds out that about 70 to 80% of the price of Bitcoin, right, can be explained with this Metcalfe law, basically the number of wallets and the number of bitcoins, right? And so here is kind of the chart, So obviously it's a volatile currency; is going to go up and down, right? But for the most part, if there are more users in the system, the price of Bitcoin is going to be higher. If there's less users in the system, the price of Bitcoin is going to be lower. It's really, really that simple. Now, I have to add to this is that to there is a cost of production of Bitcoin, right, which constantly increases, right? So Metcalfe law is true for as long as the price of the Bitcoin, right, is above the cost of production, right? So if it's above the cost of production, the miners don't have to sell it, to pay for the electricity, because basically you need to spend money on electricity to secure the Bitcoin network and to facilitate transactions. So long as the price is above, everything is good, right? So you get more users, the price goes up. However, if the price goes below the cost of production, then what happens is the miners start to sell because they have to cover the electricity costs. If they're losing money, right? I mean, they can run the operation, right? So you have to pay the bills. The guy's gonna come shut you down. So what happens is they start to sell, and that drives these big drops in price in Bitcoin. So whenever Bitcoin goes up a lot, and then it goes down a lot very fast, because when it goes below the cost of production, people lose money and they sell out. But then what happens is people go out of business. The miners go out of business, right? So some of them can produce. They're at a loss. They're forced to close, right? Then they come out of the network. Then the network becomes kind of the difficulty of the network gets reduced because people are getting out, right? So Bitcoin has this mechanism to if the cost of production to go down if it can't if the price can keep up. And so then people get out, right? The cost of mining a Bitcoin decreases, right? And then eventually enough people go out, and then the price kind of can go above the usage, and then it can go up again, right? So that's kind of how Bitcoin works. It's very volatile, but it's all related to at the end of the day to the number of users. If you have users, Bitcoin goes up. If you don't have users, Bitcoin goes down. And um, let's see here. So, and this is exactly what we see. So this is a chart from the, I forget the website's name. I think it's Coin Metrics, one of those, Glassnode. So this is from Glassnode. So you can see the number of active addresses here, right? That the big yellow line is the number of active addresses. So, and the little gray line is the price of Bitcoin. But the yellow line, you see how like Bitcoin was kind of not used by anybody. All of a sudden, it started to get used by close to 500,000 people around 2017. If you remember, there was the big spike to 20,000. Why there was a spike? Well, because there was a spike in usage. There was a short-lived spike, right, which then went down. And but roughly the price of Bitcoin kind of follows the number of addresses, right? They went up to about a million, then they went down to about 500,000. So the price of Bitcoin went to 20,000, then went down to 10,000, 5,000, right? And then it stayed there for a couple years, and then over the past year, the number of Bitcoin addresses started to go up again, and then the price goes up again, right? So now we're at new heights and so forth. And that high from 2 years ago was kind of a very brief high, just for a couple of months there, around December, January, right? Right now, we've gotten to the number of addresses, and we're hanging out there for a longer period of time, right? So that's why the price is going up and keeps going up. And for as long as there are more users, the price of Bitcoin is going to go up. So, when people say like, oh, it's a bubble and, this and that, it's not a bubble, right? Like there is people, right? For as long as the active addresses are going up, it's not a bubble. Now, if the active addresses were to start to go down, right, and the price goes up, then you have a bubble. Then you have to really be, selling out of Bitcoin, right? Like if the number of users starts to go down, you want to get out of it, because then it can drop really fast. But so long as the number of users is go up, the fundamentals are good. Is going up. That's how these things are. These are the fundamentals, right? So fundamentally, Bitcoin is not a bubble. Okay. Now, let's go to another. Let's look at Ethereum. So, for example, Ethereum, just had a very hard time getting up to its, 1500 was its all-time high from 2017. It had a very hard time getting to that all-time high. Why? Well, because the usage, is not there, right? I mean, it kind of went up to about 500, 600,000 addresses, right? The usage. Then it went down to like 250, 300,000 for a few years, and then it stayed there, right? And then just over the past year, they had this DeFi, they're talking all this stuff, NFT and all this stuff. So even with all this stuff, the usage is up to 400 addresses, right? So Ethereum, there's a lot of talk in the newspapers, and there's like a whole mafia of people there, like talking about Vitalik Buterin and this and that, and they're all brainwashed, and they're all saying, like, at the end of the day, you have to look at the volume, how much volume get the network makes, and how many users. The volume comes from the users, right? So they've come up with all these kind of DeFi and all these scams, basically, to separate people from their money. That's what really are. At this stage, they're scams, right? I mean, they're going to mature. It's a lot of experimentation. There's new models of how to do market making and so forth. It's an exciting area, but it's very early on. This thing has been around for 6 months, right? People have written these smart contracts. They're constantly getting exploited. They're getting exploited because they haven't been tested. They're being tested right now on real people, right? In any case, all of this stuff, there's a lot of there's a lot of hacks. There's a lot of people lost money, so people are scared to go onto Ethereum, right? And so that's why the numbers aren't there, right? The number of accounts is about 450,000, 500,000 right here, which is still dramatically less. It's about 100,000, 25% less than in 2017. So I think Ethereum has gone up, I don't know, 10, 20% above its 2017 price, but it really hasn't been able to kind of accelerate like Bitcoin. And the reason why it hasn't been able to accelerate is because the users haven't shown up. They have, maybe they have, all these developers and stuff, but, maybe they need people like in Bitcoin, just regular people. I don't know. The point is, the price action, people were very frustrated with Ethereum. The price action makes sense because the fundamentals are there. You can't, people say Ethereum is undervalued. No, it's properly valued, right? It's valued exactly with the usage. So, and finally, with these active addresses charts, I want to show you the, Litecoin. So Litecoin is another, it's basically kind of like a Bitcoin fork. The guy copied the code, changed a couple of parameters, Charlie Lee, and then he had this cryptocurrency Litecoin, right? Which was a little bit faster than Bitcoin and so forth. And so it made sense 3-4 years ago to have something like that if the Bitcoin network gets clogged up and gets slow, which it does. So for people to be able to transfer money using Litecoin as an overflow. So that's how you see it. In 2017, at some point it dramatically grew in usage. That's when the Bitcoin network got jammed up, and so then Litecoin went up, and then of course its price went up. But then since then, there's been new cryptocurrency with new, proof of stake model, new ways to do consensus, newer technology. So Litecoin has lost this appeal as like the faster cryptocurrency or the better blockchain than Bitcoin. So now there's different kinds of better blockchains, right? That are radically different. So in 2021, the competitive landscape is very different, and Litecoin is losing out. And how do you see them losing out? Basically, people dump all the addresses, and they used to have at some point 400,000 addresses. Now they're stuck at 150,000. They just don't have the addresses, and if they don't have the addresses, the price, can't go up. So people are looking at Litecoin. It used to be $300. Now it's still 200, 250. It still hasn't reached the highs, right? Even though Bitcoin has already tripled. And the reason for that is there's no usage, there's no people. Again, the Metcalfe law in action and explaining perfectly everything. So now that you get in your head kind of the Metcalfe law, the number of users, right, and the number of Bitcoins, the supply pictures, with these two numbers, you can calculate a value, right? And, they do have a value, they're a real thing. Now you got to think about what the potential is, right? What the potential of Bitcoin is. So I did three models in 2014. So I wrote a big paper in 2014 and actually did a very heavy research. I went and looked at numbers and I calculated, and so I came up with three models of calculating Bitcoin. This is in 2014, so 7 years ago I did this, right? So I wrote this big paper. You can go find it on on my website, vixcontango.com. There's a click to go to a blog. So click on the blog and you find a link there to a paper about Bitcoin. So in that long paper, I have three models: Bitcoin as a currency, Bitcoin as a store of value, and then Bitcoin as a payment network. So Bitcoin as a basically medium of exchange, right? So of the three model, Bitcoin as a currency, basically Bitcoin is going to replace, the first model is you look at the G10, the top 10 countries, economies in the world, like, the US, China, Europe, and so forth, Brazil, and I calculate all the money in circulation, and then I also calculate how much money in the future, how much money they're going to print, right? And then basically I'm looking, okay, what if Bitcoin penetration, if Bitcoin is basically used by 1% of the people, 2% of the people, 5% of the people, right? What its price is going to be. So I increase the penetration over time, right? So basically what I calculated back then was, by 2021, that Bitcoin is going to be used by about 5% of the population, right? And it's going to be used, is going to be basically going to be represent about 2% of the money supply, right? And based on that, it would have a $1 trillion market cap, right? And its price would be about 55,000. Guess where we are right now? 55,000 for Bitcoin. So I calculated this when Bitcoin's price was $1,000 in 2014. $800,000. So this model predicted a 50%, 50 times increase, right, in the span of a year based on just a reasonable conservative prediction of its growth as people learn about it and start to use it, right? So this kind of estimates that there's about 200 million people using Bitcoin in some form or fashion, right? Whether directly or indirectly. So that's the first model. Bitcoin is a currency. The more adopter it has, the bigger the value. So based on this model, it can go to 65,000, 70,000 in a couple of years and so forth. I haven't updated this model for the next 10 years, but you can see if it goes to 10% penetration, the numbers can get bigger. So the next model is Bitcoin as a store of value, right? So Bitcoin as a store of value, basically, gold used to be a store of value. So this looks at the all the gold in the world, right? The value of all the gold in the world, and if Bitcoin takes a bigger and bigger portion of that, right? So based on that projection, which again I wrote in 2014, I had the gold price at about 1,800 in 2021, right? Based on kind of the supply of gold going up a little bit. I calculate all the gold value in the world to be around 10, around 11 trillion, right? And then so I'm projecting as gold takes a bigger and bigger piece. If it's 7.5% of so if you look at people's portfolio and they've allocated, let's say, 10% to gold, right? If they take only 7.5% of that gold allocation and then put it in Bitcoin instead, right? That would give us a price of Bitcoin of about 41,000 in 2021, right? So I think the price is about 54. So I think Bitcoin is gaining on gold a little bit faster. So basically, right now the number of 55,000 means that about 10% replacement ratio. So the people who have gold store of value, they've taken 10% of their gold allocation and they've put it into Bitcoin. So if somebody had, let's say, they have their general portfolio and they have 20% of their portfolio in gold, basically they grabbed 2%, 10% of the 20% pie, and they put it into Bitcoin, right? And I think that's kind of fairly reflective of what's happening among some of the hedge funders and so forth. So again, that model that I wrote in 2014, predicted the price of Bitcoin of about 50,000. The third model that I'm going to use, and just as a comparison, is Bitcoin as a payment network. So this is like if Bitcoin was used for payments, like Visa and MasterCard. So I take the MasterCards of Visa and MasterCard, and then basically I'm trying to calculate the price of gold. So this gives me the worst price for Bitcoin. Medium of exchange is not a valuable activity. Okay, so this one gives me a price of 788. Obviously, that's kind of a joke. Bitcoin is much higher. So clearly, Bitcoin is not being used as a payment network. So a lot of people say like, oh, Bitcoin is not used as a payment network, so therefore it has no value, right? They're correct. Payment networks don't have a lot of value. They have, in general terms, they don't have a lot of value. Like stores of value, like gold, they have much bigger valuations, right? So Bitcoin is clearly not valued as a payment network, and clearly it's too slow, right? I mean, as it gets bigger, it gets slow. That the blockchain database has to be on every computer, grows bigger and bigger over time. It's very badly designed. I mean, it was revolutionary design at the time, but they didn't think it was going to get that big, right? So if it gets that big, it's not a very good technical solution, right? So they're correct. It's not really a payment network. It's more of a store of value, and the price kind of shows you that. So I think this is I think this is all I have with the presentation here. Um, So this is how you gotta think. So this is kind of the way you think about it. I mean, Bitcoin has been around for 12 years. Its price has followed models that I've put together 7 years ago fairly accurately. There is papers that explain its value, academic papers using Metcalfes Law, right? So if people are using it as a currency in certain countries, if they're using it as a store of value in other countries, right? So in Venezuela they might use it as a currency because you know the the local currency is getting devalued massively very quickly, so they have to just do something else to pay for things. Even though Bitcoin is slow, it takes like 30 minutes to an hour to pay for things, so it's not like a credit card. But in other countries like the United States, people find it as a store of value, like gold, right? So there's a gold market, people invest in gold. So this is a smaller asset, has similar characteristics. Um, so people are putting money for that reason, right? Um, so you know people think like, oh, this is a bubble and it's all the same trade. So it's true, it's all the same trade in a sense that people are printing money, but there's also other things that are happening, right? Bitcoin is replacing gold as a store of value. This is not the same trade. This is a different trade. Like, you know, if really it was all the same trade, the price of gold would be 2,500. It would be 3,000, right? But it isn't, and it isn't because all of the money is going to Bitcoin. So within it's all the same trade, there is leverage in Bitcoin because it's a newer asset class, right? So this is a better trade, so to speak, right? And I would argue some of the new cryptocurrencies that are coming up that are proof of stake, they or even like Ethereum, or like Cardano, they're gonna have industrial use. They're do you say banks don't have value? Banks have value, right? People store their money there, then make transfers. Well, with Cardano and with Ethereum, you can store money and you can make transfers, and you can make transfers with logic, right? You send money to this guy if this happened, or send money to that guy if that happened, right? So it's like a bank. You can put some rules and regulations around the spending of the money, right? So these new blockchains, they're going to have industrial capacity, right? Like Bitcoin, okay, you look at Bitcoin as gold, but the new blockchains, they're going to have industrial capacity, right? So you use these kind of classic use cases, but you have new use cases as new form of banking system, right? So at some point, people are going to look at this as a growth investment. Look at fintech, right? Fintech is growth. People invest in Square. People invest in companies like that, right? Fintech, that make banking more efficient and make it more accessible to the millennial population. They make it accessible on phone. These are all applications that the blockchain networks are going to have in the future. And so that's an additional use case that adds to the valuation, right? So it's still very early on in this game. And, all the models that have been put together, they have explained the price action perfectly. Bitcoin is not a scam. It can be valued. The values make sense. They're backed by usage. And, you should consider it more strongly to add it to your portfolio going forward. Okay, that's all for now. I'm out.